Good evening everyone. Welcome to this another session on dollar INR, how to hedge risk on dollar INR. Today I am not going to show you any chart. Today I am going to show you certain tables of how to use forwards along with vanilla options and how that will help in mitigating my currency risk on dollar INR, especially at a time when rupee has weakened despite the fact that dollar index is weak. We have covered that in multiple videos in the past. So, in this kind of heightened geopolitical concern situation, when rupee is weak, how do I hedge for both dollar exporters as well as for dollar importers? Okay. So, I am going to take you case by case. First, let me explain for a dollar importers case. Okay. So, what is the current situation? We are standing at 88.77 as the spot, and I am looking at a 2-month position. Okay. So, 2-month forward rate is 89.08 and I take a vanilla option at the same strike price, ATM strike price 89.08, and I pay an option premium of 52 paisa. Okay. So, here what I have done is I have taken forwards, options, vanilla options as well as unhedged positions, and I have given certain proportions to each of the hedge instrument. That is what we have been saying for multiple times in the past, that the most ideal risk hedging situation or combination is of using forwards, vanilla options, and also to keep certain positions unhedged. Okay. So, here we are looking at using 50% forwards, 25% vanilla options and 25% I am keeping my positions unhedged. Okay. So, that is the combination that I have. Here I have put multiple combinations, you can have a look, and this is the payoff profile. Remember, this is the spot at maturity. Okay. The first line here, this is the spot at maturity. At different spot at maturity, how will each of my combination of forwards, options and unhedged positions work out? Okay. So, let us look at into slightly greater detail. Here 50% forwards, 25% vanilla options and 25% unhedged positions. Okay. I am standing somewhere close to here currently, okay, somewhere between 88.50 to 89, and if the market remains at this level 2 months later, then this is the net rate what I get. But if market moves, let us take first rupee gains. Okay. If rupee gains and goes towards 86, then I am stuck with forwards at 89.08 for 50% of my positions, but I get the benefit from open positions as well as from vanilla options. So, my net rate comes substantially lower to 87.67. Similarly, if market goes substantially higher, let us take if rupee weakens substantially and it goes to 91.92, here the reverse will happen. The forwards will help me, okay, vanilla options will also help me, but I will get slightly disturbed with unhedged positions where I will have to pay higher spot for 25% of my exposures. But still my weighted average rate is going to be far lower than what the spot was when it is 91.92. So, this is like a combination of forwards and options, how it will help you to moderate risk. Okay. Forward will help you to fructify or fix the price, and vanilla options and open positions will help you in capturing the market movements if market goes in your favor, but if market goes against you, then unhedged positions will be painful, but forwards and options will help in that case. Okay. So, this is the case of a typical dollar importer. Do have a look at this table in detail. Here what I have done is I have given 4 cases where I have given different percentages. Okay. The first case is where I have 1/3, 33.3% for each of the instruments. What is my net payoff? Okay. On the second, I have 40% of forwards, 40% of open and 20% of options. So, in that case, what is my net payoff? Okay. So, you can do this juggling of various combinations, but the basic bottom line is to use a combination of multiple instruments so that we are able to participate in favorable movements and at the same time mitigate risk if the market goes against us. So this is for a typical importer. So let us now and see for an exporter. Okay, the situation is the same. Okay, we are at 88.77. The forward rate is 89.08, and I take a vanilla option at 89.08. I pay 52 paisa as option premium. Here again, for an exporter, the risk is rupee gain. Okay, if rupee gains, but if rupee gains, I am protected in both the forward and the option. I only have a worry in case of the open positions where I am exposed to that strong rupee scenario. But 75% of my positions are relatively hedged, so I still get a level of 88. That is what the kind of flexibility which a vanilla option gives you. And on the reverse case, if rupee weakens, now remember, for a dollar exporter, rupee weakening is a favorable scenario. So if this happens, then I get lost in my forward because I get stuck at 89.08. But vanilla options and open positions will help me in capturing that kind of favorable market movements, and overall I will be still at 90.41. Okay, so here again, if you look at it, a combination of forwards, vanilla options and open positions, that helps you to eliminate that volatility, and it helps you to get more harmonious or even prices. So if rupee weakens, in case of an exporter, you are able to capture good levels from an open position and as well as from the vanilla option. But if rupee gains, then for an exporter, the forward, the option will help you, and you will get stuck with lower rates for the unhedged positions. So the bottom line for all dollar exporters and importers are to use this kind of a combination of forwards, options and unhedged positions. What is the percentages to be used is completely dependent on your risk appetite, on your risk tolerance. Okay, so if you want a higher percentage in forwards, that means that you will have more fixed prices and less participation. But if you want a larger percentage of options where you want to participate in your favorable movements but at the same time protect in unfavorable movements, you can have a larger proportion of vanilla options. But remember, that will tend to increase your option premium as well. The overall hedge cost will also go higher. So please apply your mind in terms of getting what is the optimum mix, what is the right combination for forwards, open and vanilla options, and that will help you in mitigating the forex risk far more efficiently rather than doing just forwards or just unhedged positions or just vanilla options. Okay, so that is it from my side. For more insights on currency and forex markets, please join our WhatsApp community.